Hi, I'm Kevin Liu. I'm a first year business major concentrating in ITM and with a minor in computing and business through the Denning T&M program. So one of my stocks is Oracle. Oracle does things a bit differently. So most of the historical values were already out last year, as the fiscal year for Oracle ends somewhere in June. So all the values were already out there for Donovan to fill in. So all credit to Donovan for the historical values, and honestly, most of the values didn't need much updating to begin with. And so, quick overview of what Oracle does. We're on Q2 right now, and Oracle offers a lot of software and database things. So their product mix is mainly things like MySQL database and hosting databases and like cloud computing spaces for their partners and their consumers. And a big thing they're trying to expand into is away from the traditional like government agencies and educational licenses and more into like things like hosting AI computing. And that's one of their biggest investments currently. I'll go into the quarter and then I'll talk about how the quarter kind of impacts the discounted cash flow model. So first, total revenue is up 16.1 billion. That should say quarterly. I don't know. It doesn't. I updated it a second ago, but it says it's up 13% quarterly. Same thing with operating income. That's also up 8% quarterly. And so a couple of other things. The free cash flow, however, despite the increase in revenue, is down a lot. It's down negative 10 billion with a capex of around like 12 billion for investments in data centers, taking up almost all the free cash flow that we generated. And that's actually the reason why the stock is down a lot. So looking at it over the past 3 years, it started around 140 before it started rising, and all the way to a peak of 301 during like September 25, and now it's all the way back down to 149. And that's because investors have a couple reasons to think this way. First, they had to take on a lot of additional debt to pay off all this capex. Additionally, they did this all for targeting the AI boom, and so investors are worried that since there's a lot of competition in that field, that the capex will not have a good ROI, as things like Amazon AWS and other cloud services are direct competitors who may outcompete Oracle, and that resulted in the huge like downfall in kind of the stock price. So here's some other things that happened. The forecast does expect there's a huge remaining performance obligation of like revenue not recognized of around $4 billion, which kind of drives this increase in revenue year by year percentage, and we expect it to increase by a substantial amount, like even more than it currently is, because of all this new investments in databases and also the 4 billion just additional that is helping it out. Also, a couple other things are that they've continued making partnerships and expanding their marketplace ecosystem through new partnerships like Broadcom and Palo Alto, so other software companies. Working into the model itself, currently we think that honestly there's like a very minimal upside because of the new PE, and the PE is down a lot. It used to be like 35 from last quarter, now it's at around 28, which resulted in kind of the intrinsic value coming down as well following that. So we find that the upside percentage is around like 2%. So it's neither like a great investment nor is it a great sell based purely off the DCF. Instead, you should think more about the kind of technical of what you think the company's competitive stance will be, especially in the future, since they've invested so much money into the like databases for AI computing. So we move into the operating margins. We think it'd be around the same. There's no reason for the operating margins to suddenly change very fast based on the conference call, and so we just went off historical values with probably like slight increases in the future and just like standard across the industry. Tax rate's the same. Diluted shares are about just like an average of what it's been, and the interest percent of debt should be about the same. However, the like amount of debt, which you'll see here from the capex increase, will be more. So the overall like debt expense should increase along with the capex percent expense being significantly more than it used to be, like billions more than it used to be, and it's reflected in kind of the values here. We think the free cash flow will probably be invested more into like obviously heavily into capex, just because like we're spending so much into it, and that kind of results in less repayments or repurchases than we traditionally would like to see. And that's kind of what's also driving the price of the stock down. So another thing would be the depreciation expense should be about the same. No reason for that to change. So that's based off historical values. And moving into kind of how that affects the average share price, we think it'll eventually, hopefully, across like 10 years or 5 years, sorry, it'll increase back to where it was like just a couple months ago in September. So overall, it was a great quarter, but the kind of huge capex investments create a lot of market uncertainty, and that resulted in a higher beta and a lower PE, which kind of created it to the point where this is just a very risky stock to invest in. It's just like the current price is probably pretty representative of the true value, and you could argue that's worth investing in the future, kind of just because of the upside potential that it used to have. But overall, based off the DCF, it's just a very mediocre stock that you should, at the current price, there's no like strong opinion. That's basically it. You'll see that the market cap also decreased a lot, which makes sense from the last quarter. And I'm pretty sure forward PE is also like projected to further decrease, or not decrease by very much, but over time, yeah. The beta also increased, as I mentioned earlier. It went from around like 1.5-ish to 1.65 because of the increased risk of the stock itself. And that's it for Oracle.